Are the days of cold, hard cash numbered? And if so, what will the shift to digital currency mean for you as an investor? Hi everyone, I'm David Scranton, and thanks for joining me right here on The Income Generation. Let's face it, it's pretty unusual to pay for just about anything today with cash. It'll only get more unusual as the world continues to shift toward digital currency. However, this shift won't be easy if it happens, and it may create some risks. Today, we're going to be sorting it all out on our show, Decrypting Digital Currency. Specifically, we'll cover the basics of digital and cryptocurrencies, their advantages and their disadvantages, risks and opportunities for investors, and what it all means for income investors specifically. And helping me out as usual is income specialist and best-selling author Jeff Small. But we're also going to be hearing from our special guest, options trader and author John Najarian, as well as income specialists Michael Easton and Matthew Johnson. And as always, we'll answer your retirement questions. But first, let's talk about just what we mean by digital currency. Well, very simply, digital currency is any form of currency that's available only in digital or electronic form. Electronic versions of currency already dominate most countries' financial systems, right? I mean, here in the US, physical currency now makes up only 1/10 of the overall money supply. The rest, while it's based on the US dollar, is held in banks in electronic form. But what makes digital currency different from this electronic money that you currently have in your bank account? Well, it's the fact that it never takes physical form. Digital currency always remains on a computer network and is exchanged digitally. Currently, digital currencies are most broadly used among certain online communities, but that's changing. Many small and many online businesses now actually allow purchases with Bitcoin as well as other forms of digital currency. And so do popular shopping sites like Etsy and Overstock. So the question is, does the shift to digital currency mean that we'll all be paying for everything with Bitcoin in a couple of years? Well, probably not. It's more likely, if it happens, that we'll have an established CBDC, a central bank digital currency, which is backed and regulated by the Federal Reserve. While it only exists at this time in concept, at least 80% of the central banks around the world are running experiments with the CBDC. All of this, if you think about it, is actually putting pressure on our own Federal Reserve to move forward quickly on an American version of the CBDC. Even more pressure is coming from the expanding popularity of Bitcoin. Bitcoin, Ethereum, and other cryptocurrencies are a subset of digital currency that currently exist in an unregulated form. And these are controlled by their developers and use cryptography to verify transactions. And by the way, to manage the creation of new currency. Cryptocurrencies have been hot among speculative investors for years now, as you probably know. Will that change? And if so, how? That's something we'll be talking about coming up shortly. But before we talk to Jeff, let's take a moment to answer one of your retirement questions. James from Oregon asks, why are cryptocurrencies so hot with investors? Well, James, I believe the answer is because people are worried about all the debt today in the country. And they're worried about a failure of what we call our fiat currencies, that is the US dollar or the euro, due to this massive explosion of government debt. And as a result, the trend is to go toward gold and to cryptocurrencies, because let's face it, there's not enough gold anymore to back up the monetary system. So that's a big part of it. And of course, the other part of it is just people are speculating. Bitcoin and other cryptocurrencies have gone up in value, and it's the new sexy topic, and that's what I believe makes it so popular. So James, thanks again. Be sure to send me your retirement questions by emailing me at askdave@theretirementincomeStore.com. And now it's time to bring in my good friend and co-host, Jeff Small. as well as today's special guest, John Najarian. He's an options trader and co-author of the book, Follow the Smart Money. John, thanks so much for being back with us here on the Income Generation.
David and Jeff, it's always a pleasure. Thank you.
So we've got some great news today, John. Bitcoin is off 50% from its highs, but it's back in the penalty box due to the China smackdown. So tell us what your thoughts are in that regard.
All right, that's pretty easy, Jeff. The problem with China is, of course, they're kicking out all these miners. They're telling their banks not to deal with crypto in any way, shape, or form. And so a lot of those miners, of course, virtually all of them are moving out of China, where they had sweetheart deals with energy right near hydroelectric dams and things like that. Now they've got to raise cash, which means sell Bitcoin. And because they have to pay for the trip, they have to pay to move all those rigs, they have to buy a new place or rent it. I mean, all these things occurring just into this Ethereum expiration, which is this Friday. That's the Ethereum option expiration. I think that was a perfect storm, Jeff, for why Bitcoin traded beneath 29,000 yesterday.
And the average investor gets shellacked. That's just wonderful. So is this a permanent move by China, or is this going to be something they really want to get a hold of and take control of because they see it as a threat to the yuan?
Well, they definitely see it as a threat, Jeff. But if Bitcoin survives this, which I believe it will, it's a decentralized finance or DeFi. And then you've proved out exactly that the most totalitarian regime with the most draconian measures short of death penalty, if they can't stop Bitcoin, then Bitcoin can't be stopped. So this was a big test, obviously, and a lot of FUD, fear, uncertainty, and doubt thrown at the market very fast. That all came to a head at the end of June 2021. And that's, I think, going to be behind us going forward.
Really quick, John. So you think these miners will reestablish outside of China versus just closing up shop?
Oh, yeah. I think the answer is that those miners are moving. We know they're moving to Maryland. They're going to go anywhere in the United States or elsewhere where they can get hydroelectric, geothermal, solar, wind, or if they have to, natural gas and coal, because these rigs cost a lot of money. They need cheap electricity. They are coming to the United States. We might be the United States of Bitcoin very soon.
Well, let's just hope that the country with all these draconian measures isn't draconian enough to try to keep these people from leaving the country of China. So, yeah. John, don't go away. We're going to talk more after the break. And we're also going to be talking about the potential advantages of a digital currency system, as well as some of the potential risks. All this and more coming up on the Income Generation.
Are you truly ready to retire? Do you have the right strategy to pay for your lifestyle for the next 30 years or more? Take our free retirement readiness quiz at areyoureadyforretirement.com and discover what your retirement strategy may be missing. Don't let market volatility derail your retirement plan. Make sure you're fully prepared by learning about hidden risks to your retirement. Visit areyoureadyforretirement.com and take our free retirement readiness quiz.
Welcome back to the Income Generation. I'm David Scranton, and today we're decrypting digital currency just for you. And I'm here with Jeff Small, as well as our special guest, author and options trader, John Najarian. John, thanks for sticking around.
Thank you. Great to be with you both.
So I guess, John, based on everything we've discussed thus far, it's really a great opportunity to buy Bitcoin at this current state of decline that we're in.
I agree with you 100%, Jeff. I did that. I bought more Bitcoin on the drop. I didn't buy the low, but I did buy. I also bought Ethereum on the drop. I think a lot of this is that combination, fear, uncertainty, and doubt, China, as well as this big expiration for Ethereum options. And all of that just puts downward pressure on these cryptocurrencies. You could throw influencers like Elon Musk, who's flipped back and forth, like a windsock on cryptocurrencies in there as well. But I think all that'll be behind us going into the next quarter, Jeff.
So you're not worried about the grumblings we're hearing that the Fed might step in and put some regulations in there?
No, I'm not. They already have plenty of regulations. I think overall, decentralized finance means they don't have to play by the Fed's game. The Fed could basically say, look, you can't trade these assets anymore. They just go through VPNs and do it offshore. Now, obviously, it doesn't grow as fast if you have to go through virtual private networks to do that. But I think decentralized is the key to why Bitcoin is so successful and why most of these people, including Gensler, who taught a course in Bitcoin at MIT, knows you can't really stop decentralized finance.
So here's something I'm really curious about, John. How much leverage is there actually? You have any idea in the Bitcoin market? How many people are borrowing to invest into Bitcoin?
You hit the nail on the head. That's the problem. And that's why I focused on the Ethereum expiration of options this Friday, the 25th, because you can get 100-to-1 leverage in a lot of places around the internet, whether it's Deribit or Binance or any of the offshore exchanges, FTX, you can tend to get huge amounts of leverage. And if you could get 100-to-1 leverage in Apple, I would say you'd see Apple swinging around like you're seeing Bitcoin swinging around too. It's leverage. That's one of the issues.
Sure. So I hear you loud and clear, John, that it sounds like you're not one of the naysayers who think that it's going to be the next tulip mania where eventually it goes to zero. We all look back and say, what were we thinking? So if it's going to be here to stay, then the question is, where does it fit into the portfolios of members of the income generation? Those of us, all three of us over the age of 50, right? Many of whom are getting close to retirement. How's the best place for them to use it, or is it appropriate for them?
I think it is appropriate. You heard Paul Tudor Jones just say last week that he thought a 5% allocation into cryptocurrencies, I think in particular, he said Bitcoin, was appropriate. I'd say anywhere from 2 to 5%. I would not say more than that. Whenever my particular holdings have performed well, which they haven't, quite frankly, in the last 30 days, but when they've performed well, I've constantly pared them back to bring myself back to a maximum of about 4 or 5% for my holdings. And that's what I'm comfortable with.
So the Paul Tudor Jones camp is really, hey, it's like the new digital gold, 2 to 5%, same thing as you would traditionally with regular gold. But how about for income? You can lend it, you can use it for miners, you can get income. But is that a steady enough income source for retirees on that small portion of their money?
Well, that's one of the great things is those tethered coins like Tether itself pays about 8% on platforms like Voyager, where they'll pay you to deposit your crypto there because then they can lend it out to the market makers. I think things like that or selling futures forward contracts against your Bitcoin lets you make between 14 and 30%, depending how far out and which strikes you pick. I think that's fabulous. So that's what I do with my crypto is I write upside calls against it to get that income.
Got it. All right. Well, so much for the naysayers then. I got it. It's here to stay, but just be careful. A very pungent spice is good in a recipe in small increments, but if you put too much, it ruins the dish. And same thing here. John, thanks so much for being back with us. We appreciate it.
Thank you both.
So far we talked a lot about digital currency, but now let's break down some of the advantages and some of the potential risks of a digital currency system. Digital currencies do offer many advantages over physical currency. The main one is that transactions are made directly between a buyer and a seller without the need for an intermediary like a bank. And that makes them faster and, yes, cheaper. They also offer constant access. You see, currently, electronic money transfers that take place outside normal business hours can actually take longer. But with the digital currency, transactions work at the same speed 24/7. A digital system would also make government payments more efficient. With the CBDC, Uncle Sam could deliver your tax refund or your Social Security check instantly rather than actually mailing you a physical check. And since all digital financial transactions are electronic, the need for transparency and documentation is automatically covered. So, what about the disadvantages? Well, one is confusion. You know, there are so many cryptocurrencies being created across so many different networks that it's hard to keep them straight. Adding a CBDC to the mix could possibly increase the confusion for consumers, which is just one of the many challenges facing the Fed. But another is the learning curve. See, digital currencies take work. They take work to learn how to perform basic tasks. The whole system will need to get simpler for it to work more broadly. Another challenge is security and ensuring consumers that their digital accounts are safe from cyber attacks. So developing a CBDC will not only take time, but it will also cost money, meaning tax dollars. And finally, digital currencies have so far proven to be very volatile, more volatile than a normal currency by a large margin, something that we'll be talking about more in a bit. But now it's time to get to another one of your questions, this one from Rick from Illinois, who asks, you know, this is off topic, but what are your thoughts on venture capital investing? Like if a friend is starting a business. Well, Rick, obviously you've got to be very careful. Venture capital investing is the riskiest type of investing because you're dealing with a startup company, and over 90% of startup companies fail. So best advice would be to do your due diligence and to only get into this if this is extra money that you can afford to lose. If this is money that you really need to grow for retirement, then I would advise you strongly to stay away from venture capital investing. Even though it might be a friend, you might feel an emotional obligation to help your friend, but at the end of the day, it's not worth sacrificing your own financial security during retirement. So Rick, great question. And if you have a question, just email me right here at askdave@theretirementincomeStore.com. Now, let's bring back in Jeff Small.
Dave, you know, I think that digital currency is the ultimate form of gambling, and obviously the hyper volatility of digital currency is a true indicator of that. And now people are even using leverage and buying on margin through Bitcoin.
Yeah. Well, and like John said a few moments ago, the reality of it is that right now, in its current form, it is too volatile to really be a functional currency. The hope is that volatility will flatten out as the years go on, so that by the time we're ready, if we come ready to adopt it as a currency, that volatility has really, is really taking care of itself. Otherwise, it'll never be a digital currency. I completely agree. So Jeff, thanks. We got to take a quick break here, and coming up, we'll talk more about what the movement toward digital currency could mean for consumers and investors. Plus, we'll talk to income specialist Michael Eastham from Florida. All that and lots more coming right up.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
Welcome back to the Income Generation. I'm David Scranton, and thanks for tuning in as we decrypt digital currency. And so far, we've covered some basics, and we've also talked about the risks and the benefits of digital currency. Now it's time to talk about what all this could mean for you as a consumer and an investor. You know, it's impossible to discuss digital currency without mentioning the impact that this sector has already had on the financial markets, particularly among speculative investors. And the topic is even more important now that Coinbase has become the first major cryptocurrency-related company to go public in the US market. Based in California, Coinbase allows people to buy and sell about 90 different cryptocurrencies. And the company just went public back in April. And that's significant because it means that you, as an everyday investor, somebody who may have been nervous about getting in on the digital currency craze can buy stock in a company registered in the SEC and kind of sort of indirectly profit as cryptocurrency prices increase. And that might make the entire prospect seem less speculative and less risky. But be careful, because believing any kind of hype about a certain market sector or a specific new public offering is always risky. In fact, it can also greatly increase your overall risk if you adjust your portfolio based upon the hype, especially if the adjustment involves putting all or most of your eggs into one basket. And as I said to Rick just a moment ago, from Illinois, that venture capital, you want to focus on money that you can afford to lose, and the same is true with your thoughts if you were to take the step and invest in cryptocurrencies today. Keep in mind that according to a University of Florida study, most initial public offerings, referring back to the Coinbase, lose investors' money within 5 years. Now, we don't know specifically about Coinbase, but keep this in mind, please. And also keep in mind that every financial risk you take after the age of 50 seems even riskier. Why? Because you no longer have a lot of time to recover from any major losses. And you'll soon need your assets to start generating income. So does that mean you shouldn't take any risk, or that you can't get in on the digital currency craze? We'll talk about that coming up in just a moment. And now let's get to another one of your questions. Janet from Texas asks, what makes cryptocurrency such a risky investment? Well, at this stage, it's a risky investment because it is speculative and because it has no real underlying value. Precious metals like gold and silver actually have an industrial use, and cryptocurrencies don't have any basic use. So all the speculation is really around how widely accepted they will be as a form of payment. Or conversely, will they get outlawed, as China's trying to do right now? We're trying to regulate it so that they won't be used, in which case ultimately the value could go to zero. And it's that big question mark that stands out there that's causing this incredible volatility right now. So Janet, thanks so much for your question. And be sure to send me your retirement questions by emailing me at askdave@theretirementincomeStore.com. Well, Jeff, now it's time to introduce another one of your favorite guests to the show, someone who is my personal cryptocurrency advisor, and that is income specialist Michael Eastham. He's founder of Fellowship Financial Group, a retirement income store located just outside of Orlando, Florida. He's also best-selling author of the book, Common Sense Income Strategies. Michael, thanks so much for being back with us here on the show.
It's always good to share some time with you guys.
So Dave, you forgot to mention not only my favorite guest, but also my neighbor, just an hour away. He's close.
Very true. Yes, sir. Yeah.
So Michael, have you heard of many questions from your clients or potential clients about cryptocurrency in the last year or two?
Oh yeah, we've gotten quite a few inquiries and questions, and people just wondering, what's going on with it, and how can they kind of be a part, if you will.
Yeah, there's kind of a FOMO environment with cryptocurrency. Even the older investors are inquiring about it. But what is your basic message to retired investors right now about this crypto craze?
Well, it's funny you brought that up specifically, because I'm always telling clients, beware of the FOMO, beware of fear of missing out, because it can be very deceptive. The bottom line right now is that crypto it's a speculative bet, and it can be very complicated, very confusing. And the bizarre thing to me is, you're right, Jeff. I mean, people are just jumping in without really understanding what's going on, and that is a scary thing to see, to tell you the truth. So my advice to the older investors is pretty much, move forward with caution, but make sure you're educated. Don't just jump in because everybody's talking about it. That's the wrong thing to do.
Yeah, I kind of see cryptocurrency as, you buy the lows, or you buy the lows and you sell the highs, and you get in and you get out. It's not, or you got to hold it for the long term, let's say. and just it's speculative bubble money, money that you can afford to live without. But, I don't really see it affecting our industry, our practices. I think people are going to treat it like a small inflation hedge in a gold or energy position. How do you feel about that, Mike?
Well, I think that's missing the big picture, to tell you the truth. I mean, there is a broad potential application for cryptocurrencies, not only industry-wise, but on a global basis. But it's just going to take one of those, it's going to take some time for that to develop if it's actually going to prosper. So I think that the bottom line is that if you're proactive and you're trying to learn about different things, then it can be a good value add in terms of the advice that you give clients. If you're looking forward to what's going to impact our economies going forward, then
even though it's fallen 50% from its high, Mike?
Well, look, the stock market's fallen 50% from its high multiple times. And people are still jumping in. They're still using it as a value over the long run. So
that's a good point. So whereas it doesn't fit in an income portfolio, you're saying in a growth portfolio that has lots of stocks, maybe using it as a hedge, almost like a digital gold, is where it could fit in. But again, more for the G, the growth, not so much the I, the income. Is that, if I'm hearing you correctly?
Mostly the G at this point. However, there is an element that is developing now. It's kind of in an infancy stage where income can be an opportunity. But again, this is one of those don't try this at home things, because you've got to know what you're doing or else you can really fall into the wrong hands.
Now, it's interesting because a lot of people think it's here to stay. Cryptocurrencies are here. The question is, which ones are going to be the more permanent cryptocurrencies that last longer? And of course, Bitcoin has the biggest head start out there in the market. But there's some that think it could be the next tulip mania because there's no industrial use for Bitcoin like there is gold and silver. And that someday everybody will look back and say that was the biggest speculative bubble. How do we ever fall for it? Your thoughts?
Well, I think that's a little naive, simply because of the fact that the blockchain technology on which Bitcoin and other major currencies are built, that has tremendous industrial application, not necessarily in the manufacturing sector, but certainly on the consulting side, on the IT side, and on the systems development side. So there are a lot of actual applications for cryptocurrency on the blockchain, and you're seeing that by the foray of major consulting organizations and major technology organizations around the world.
Yeah, more and more big companies are certainly adopting it, which is certainly an argument to back up what you just said. So, Michael,
and I don't mean just investing in it; I mean actual applications.
That's right. That's right. No, I understand that. And Michael, thanks so much for joining us. Always great to have my own cryptocurrency advisor on the show with us. Coming up, we'll talk more about the potential impact of the digital currency movement on investing for income. And we'll also welcome our next guest, income specialist Matthew Johnson from Iowa. We'll be right back. I'm David Scranton. During my career, I found that most baby boomers have done a great job growing their retirement savings, yet many don't know how to convert their savings into steady income. And that is why I built the Retirement Income Store, to help hardworking Americans preserve their assets and establish steady streams of income.
If you're 55 or older, our free Retirement Income Kit is for you. It's chock full of information you need to know to get steady income during your retirement. Call 866-710-1749. Online at theretirementinComestore.com.
Welcome back to the Income Generation. It's great to have you here. I'm David Scranton, and today we are decrypting digital currency. And so far we've covered the following: the basics of digital and cryptocurrencies, the challenges, the benefits, and the potential risks for investors. So now let's talk about digital currency and specifically investing for income. So if you've watched our show before, I hope you have, you probably recognize this formula because it illustrates the financial principle that total return is a sum of both growth as well as income. Growth is measured by capital gains, while income is generated through interest and dividends. And when you shift your financial strategy from growth to income, you're investing in things designed to reliably generate return that come in the form of interest and dividends, and oftentimes at a fixed rate. Now, the key words are reliably and even fixed. Regardless of any market volatility, you can count on getting your income return at pretty much the same rate on a predictable time. And with the help of an income specialist, you could potentially increase it. So what does that have to do with digital currency? Well, it's important to know that neither Coinbase nor any cryptocurrency or any cryptocurrency company currently pays a traditional dividend, whether it's on the currency or whether it's on its stock. Now, some do currently pay a periodic reward for simply holding the currency in a digital wallet or for taking a specific action. However, those are different from stock dividends, which are paid to shareholders from company profits. So here's the point. So far, the digital currency movement has really not provided any practical opportunities for income-based investors, including those with a higher risk tolerance who want to stay in the stock market. So could that change? Of course it could. But if anything is certain, it's that the digital currency craze is more than a craze. It's a significant economic change that's going to be with us for a while, if not forever. So now let's take one final question from you. Dwight from Maryland asks, why do some companies pay dividends but others don't? Well, the major question, Dwight, your answer to that question is simple. Younger companies that have lots of growth opportunities don't want to pay dividends out to shareholders. They want to reinvest those dividends internally so they can grow the company. It's deemed that they can grow the company faster through internal reinvestment. But when a company gets more to its mature stage of development, where now it doesn't have as many internal opportunities for growth, then it's rather pay some income out in the form of dividends to shareholders. And bottom line is that they do what they think the shareholder will most want. Because remember, the fiduciary responsibility of a CEO of a publicly traded company is always this. It's to maximize the value for shareholders. And part of that's making the decision, do we reinvest the profits internally or pay them out in the form of a dividend? So Dwight, a great question. Thank you so much for it. And once again, be sure to send me your retirement questions by emailing us at askdave@theretirementincomeStore.com. And now let's, for one last time, bring back in Jeff Small.
Financial advisors and income specialists probably won't change much in their shift to digital currency as a practice with their customers, Dave, because their customers don't want that kind of speculation in their portfolios.
Yeah, you know, it's first of all, income specialists, absolutely. Income specialists are not going to make a big change. Why? Because it doesn't provide income. And yes, you can lend it out and use the coins for miners and so on, for mining, and get some income from it, but it's not consistent, it's not predictable. Now, some advisors who aren't income specialists might use it. There's studies that call it the new digital gold. So the whole idea is that if you put a little bit in a stock portfolio, it could actually lower the overall volatility. And I've read some of those studies, but I'm not necessarily ready to buy into it yet, Jeff.
That makes two of us. I mean, Bitcoin's down 50% in the last month. China just announced a Bitcoin data mining suspension. And so there's regulatory scrutiny here in the US. So, I mean, it's not the place for a conservative, pre-retired, or retired investor to be.
Yeah, absolutely. And again, unless it's just speculative money, you already are on target for your retirement goals. You have enough. And now it's a question of, okay, do I want to try to have some fun? You know, maybe this is my retirement boat money. I throw in Bitcoin and, you know, if I retire and can't buy a boat, it's not the end of the world. But if it goes up 10 times, then hey, I get to go fishing more often, that kind of thing. So I think that's how income-based investors need to look at it, who've already made that transition from the G to the I, from growth to income. And Jeff, now it's time to bring in our final guest, and that's income specialist Matthew Johnson. He's president of Johnson Wealth and Income Management, a retirement income store located in the great state of Iowa. Matthew, thanks so much for being back with us here on the show.
It's my pleasure. Thanks so much.
So Matthew Johnson, all the way from Iowa. You know, there's a new digital currency. It's called digital corn. Did you hear about that?
Coinbase.
Sounds like I'm going to have to go ahead and get a new combine.
No, seriously though, the crypto craze is in full effect. Are your clients inquiring about cryptocurrencies and putting some of their money in them in retirement?
Absolutely. There's a lot of curiosity. There's a lot of questions that I'm fielding every single week with regards to cryptocurrency. Yeah.
So as a fellow advisor, though, Matthew, how do you see the shift into digital currency impacting your job with your clients, if at all? Do you think it's relevant?
Well, I think it's very relevant. It kind of takes me back to the days when the internet first came into existence. And I remember my dad saying, well, just be careful. This is probably a fad. It's going to go away, right? Cryptocurrency, when we really kind of get into the roots of it, cryptocurrency is so wonderful because it allows so many other individuals from other undeveloped countries to actually have a currency, to be able to have the ability of buying things and that sort of thing. And the technology has really grown. It's very much adapted, and it's gotten so much better, and people are starting to get interested into it. So I do think that it's here to stay. It's something that we're going to have to, be very careful to advise clients on. And it's going to be something that is a part of our everyday life. I'm certain of that.
Well, cryptocurrency, people confuse that with blockchain. I think blockchain is here to stay. Cryptocurrency, MJ, China just put the lockdown on mining any more cryptocurrencies over there. And, what China gets, what they want, they get. And so now they're talking about more regulation here. So we could be looking at a huge speculative bubble in those cryptocurrencies because lots of wealth has been created. So what do you think is going to happen going forward, even though it's 50% off its peaks?
Well, here's the thing. Like you said, it trades a lot like a commodity. So it's down in 3 months, roughly 45%, right? Well, when people consider what goes on within the oil world, within the precious metals world, cryptocurrency is something that you can use in your life as something that you can buy on the low and you can sell on the high. The average time chain or time frame of holding cryptocurrency is like 58 days. It's a very short-term cyclical type of investment. And it's something that I think you could deposit some money into. You can hold it, but certainly don't rely upon it for a steady growth. When we turn back the clock to the turn of the century, when the stock market lost 50%, it took 3 years to do that. Cryptocurrency just did that in 3 months. So it's something that you definitely don't want to be investing your long-term life savings into. It's not a good bet in that regard.
How about some of the articles? We've both read CFA-based articles that say, hey, it's the new digital gold, that just like gold, putting maybe 3% of it into a stock portfolio, a growth-oriented portfolio, can actually be a bit of a hedge, can actually lower your overall volatility risk. For the more aggressive investor who hasn't transitioned to income yet, that's still growth-oriented, is there a place for it there?
Well, of course, I think that it could most definitely have a place in a person's portfolio. We're just going to need to make certain we're only investing the money we can afford to lose, because it is a very speculative thing. It's also very volatile. The other thing to keep in mind is the fact that even though cryptocurrency is developing, and yes, there is these things that they would call a pseudo crypto dividend, that's very much different from the dividend dollar you're going to get paid from a stock, or say the interest that you're going to get paid by the bond. And the reason being is that we're still really limited as to what we can buy with cryptocurrency as a good or a service, where if you get paid $1 of a dividend, that's going to be accepted anywhere for anything you want to buy.
Yeah. Matthew, as usual, all great points. Thanks again for being with us here on The Income Generation.
It's my pleasure.
And a special thanks to you for joining me once again right here on our show. And thanks to Jeff Small and all of our guests. We've had a great time today. Bottom line, if you're close to or if you're in retirement and you're concerned about your money, it's essential you stay informed and up to date. And as you know, right here is where you can do it on The Income Generation. I'm David Scranton, and look forward to talking to you next week.